MKS Instruments decisively beat Q2 2026 consensus. I mean, revenue came in at $1.248 billion, up 28.3% year over year, and that beat estimates of $1.20 to $1.21 billion. Non-GAAP earnings per share, that hit $3.30, crushing their 2.91 and 2.96 estimates. And Q3 guidance was also raised above consensus. So revenue is guided to $1.35 billion plus or minus $40 million, and EPS to 3.58 plus or minus 31 cents. But despite this massive beat and raise, the stock dropped 4.89% in after hours, trading to $297.77. And then it fell nearly 7% in the following regular session before, institutional buyers finally step in. Okay, let's unpack this. Our mission for you today is figuring out exactly why a textbook beat and raise quarter triggered such a steep sell the news reaction, and whether this represents a buying opportunity or a glaring warning sign for retail investors.
Yeah, it's really the ultimate paradox of current market dynamics. I mean, you have a company posting just phenomenal numbers, but the market reacts with immediate skepticism. So to understand the disconnect between the numbers and the stock reaction, we first need to look at where the revenue beat actually came from, which really reveals how deeply embedded MKS is in this whole AI hardware supercycle.
Yeah, because when we talk about the AI supercycle, we usually focus on the companies designing the final chips.
Exactly.
But MKS sits at a very, very different level of the supply chain. Like, they aren't the ones selling the luxury sports car. They're the ones machining the spark plugs.
That's a great way to put it.
Right. So let's look at the semiconductor segment. That brought in $554 million, which is up 28% year over year. And management highlighted broad-based growth across their deposition and etch products.
Right, and when we discuss deposition and etch, we're talking about the absolute fundamental physical processes of chip manufacturing.
Right, the real nitty-gritty.
Yeah, exactly. Deposition is it's the highly controlled process of laying down ultra-thin films of materials onto a bare silicon wafer. And then etch is the reverse. It's carving microscopic patterns into those materials to create the billions of transistors that will actually make a chip function.
So where does MKS come in?
Right. Well, MKS provides the critical vacuum subsystems, the plasma generators, and the reactive gases that actually allow those massive fabrication tools to operate with extreme precision.
Wow.
Yeah, and what really stood out in this quarter's print was the surge in NAND upgrade activity.
Okay, let's clarify what NAND is real quick for anyone looking at their portfolio's semiconductor exposure. NAND is flash memory. It's the storage technology inside data centers, solid-state drives, smartphones.
Right.
It holds data even when the power is turned off, unlike the active processing memory we usually associate with GPUs. But here is my pushback on that revenue driver.
Okay, let's hear it.
If you look at the broader industry roadmap, greenfield NAND fabs, meaning the brand new from the ground up manufacturing facilities, those aren't scheduled to come online until late 2027 or early 2028.
Right, that's true.
So how exactly is MKS putting up 28% growth numbers today if those massive new factory builds are still, years away?
Yeah. So the answer lies in the mechanics of the upgrade cycle, specifically the difference between greenfield expansion and brownfield upgrades.
Oh, okay.
While the brand new factory shells are indeed a few years out, semiconductor manufacturers, they just can't wait.
You need it now.
Exactly. They are urgently upgrading their existing facilities right now. They're migrating to higher layer count 3D NAND, which is absolutely essential for these high-capacity AI storage servers.
Right.
And to understand why MKS is benefiting so heavily, we really have to look at the physics of 3D NAND. Instead of shrinking memory cells horizontally, which has kind of hit physical limits, chip makers are stacking them vertically.
Like a microscopic skyscraper.
Precisely, like a microscopic skyscraper.
And building that skyscraper requires a very specific set of tools.
Yeah.
You essentially have to punch an elevator shaft all the way down through hundreds of microscopic layers of silicon, right?
Yeah.
Without bowing the walls or widening the hole.
Right, and digging that microscopic elevator shaft requires high aspect ratio etching. You can't just drill it mechanically.
There's not.
You use a highly energized plasma to chemically burn through the layers. And creating and controlling that plasma requires immense amounts of radio frequency power, or RF power.
Okay.
And MKS essentially dominates the market for these specialized RF power generators.
Oh, wow.
So when a factory upgrades its existing tools to handle this complex 3D etching, MKS's RF power content represents the single largest part of the bill of materials for that specific upgrade.
That makes total sense.
Yeah, they capture a massive share of the equipment spend without a single new factory needing to be built.
So the mechanics of the AI memory requirements directly feed their revenue stream on existing factory floor.
Exactly.
But, as strong as that semiconductor segment was, the real outlier was the electronics and packaging segment, the E&P.
Oh, yeah.
That division brought in $381 million, which is just a massive 44% jump year over year.
Yeah, and the E&P segment is a direct reflection of the physical limitations of modern computing.
How so?
Well, RF power etches the silicon, right? But you still have to connect those finished chips to the rest of the computer to power them and transfer data.
Right.
You can't just build a faster AI GPU. You have to mount it on incredibly complex, high-density printed circuit boards, or PCBs. Standard rigid circuit boards, they just cannot handle the heat or the data bandwidth required by advanced AI servers.
It probably just melts.
Pretty much. They need specialized high-density substrates and flexible PCBs.
We use the phrase picks and shovels constantly when talking about the AI gold rush.
Yeah, all the time.
Usually people mean the companies assembling the server racks. But in this case, MKS is literally providing the underlying tools that make those circuit boards possible.
Absolutely.
I mean, their AI-related chemistry revenue jumped from just 5% of total chemistry sales in 2024 to somewhere between 15 and 20% right now.
That's a huge jump.
It is. And management stated on the call that demand for their chemistry equipment is, quote, easily the strongest it has ever been, with order visibility extending all the way into 2027.
Yeah, and to understand that demand, we need to look at how these advanced PCBs are actually manufactured. When you're stacking multiple layers of circuit boards to save space and increase data speed, you have to connect the electrical pathways between the layers.
Right.
This is done by drilling microscopic holes called vias. And MKS provides the specialized laser drilling equipment that punches those holes with sub-micron accuracy.
Wow.
But drilling the hole is only half the battle.
Right, because a hole doesn't conduct electricity. You have to fill it with copper.
Exactly. And you can't just pour molten copper onto a circuit board.
Right, the entire board would melt instantly.
Yes. So this is where MKS's proprietary wet chemistry comes in. Through their Atotech division, they provide the highly specialized electroplating chemistry that allows copper to grow perfectly inside those microscopic holes at room temperature.
That's crazy.
It really creates flawless electrical connections between the layers. As AI servers require denser, thicker copper pathways to handle massive electrical currents, the demand for MKS's specific electroplating chemistry just skyrockets.
So their chemistry is basically the bottleneck for the entire industry's advanced packaging.
Pretty much, yeah.
And just to round out the revenue picture, that exact same precision technology translates to other sectors. Their specialty industrial segment brought in $313 million, up 14% year over year.
Right.
That chemistry and vacuum precision is heavily relied upon by the defense sector and datacom applications for things like laser communications. So you have a quarter where every single operating segment is accelerating.
Which brings us to the core mystery of our analysis here.
Right.
The top line is pristine. Demand is at record levels. Visibility extends into 2027, so why the 7% sell-off?
Yeah, why?
If the revenue engine is humming perfectly, the drop has to be rooted in the cost of facilitating that future growth.
Right, because when you are ramping up physical manufacturing to meet record-breaking demand, the scaling process requires serious capital.
Oh, absolutely.
The conversation on Wall Street immediately pivoted from the surging capacity requirements to the resulting margin compression.
Yeah.
Let's look at the metrics. Q2 gross margin hit 47.6%. On the surface, that looks healthy, but management clarified this included about 100 basis points, which simply means 1% of discrete benefits from tariff and duty refunds.
Right.
So if you strip away that 1%, the underlying margin is slightly lower.
And looking ahead, Q3 gross margin is guided down to 47.0%. To understand why that margin is compressing, we have to look at their capital expenditures, or CapEx.
The cost of doing business.
Exactly. To meet that guaranteed demand visibility they have through 2027, MKS is aggressively expanding its physical footprint. They just opened a massive supercenter in Malaysia during the second quarter.
Oh.
Yeah, and they're also actively doubling the capacity of their Guangzhou chemistry equipment factory, with a second facility coming online in Q3 of 2027.
That's a lot of building.
It is. Overall, CapEx is going to run at 4 to 5% of their total revenue.
See, I have to challenge the market's reaction on this front. MKS generated $188 million in free cash flow in the second quarter.
Right.
That is a full 15% of their revenue flowing straight to free cash flow. And they aren't just hoarding it either. They proactively paid down $100 million of their term loan, bringing their leverage down to a very manageable 3.0x.
Yeah, that's a good move.
Right. So are investors being completely short-sighted here? It looks like they're punishing a company for expanding its capacity to meet guaranteed, highly visible future demand while still generating massive cash.
Well, if we connect this to the bigger picture, you have to understand the mechanics of how institutional money values semiconductor equipment stocks right now.
Okay, walk me through it.
Wall Street relies heavily on discounted cash flow models, which project a company's future cash flows and discount them back to their present value.
Right.
These models are intensely sensitive to near-term margin degradation. So when an analyst sees gross margins ticking down from 47.6% to 47.0%, while capital expenditures for new factories are accelerating, the math in those models immediately flags a near-term hit to profitability.
Ah, I see.
Institutional semiconductor investors just have an incredibly low tolerance for this kind of margin pressure. Even if management explicitly gets on the earnings call and states that these factory ramps are a deliberate strategic trade-off to capture market share through 2027.
Wow. So we're basically watching a tug of war between a company's long-term physical execution and Wall Street's short-term algorithmic modeling.
Basically, yeah.
But margin pressure only explains part of the story. If we zoom out to the broader market context and look at some of the internal corporate flags on the balance sheet, the bearish argument really starts to crystallize.
Right, because valuation is the primary headwind here. Going into this print, MKS was trading at a demanding 65 to 67 times earnings.
That's steep.
Very steep. If you're holding MKS in your own portfolio at a 65x multiple, you are essentially paying top dollar for absolute perfection. You have virtually zero margin of safety.
Right.
Any slight margin headwind or any hint of elevated capital spending is going to be severely punished.
Yeah, that makes sense.
And you also have to view this within the context of the broader sector consolidation. Look at ASML, which is arguably the most important lithography equipment maker in the world.
Right, massive company.
Their stock experienced a 16.6% drop in July. The entire semiconductor equipment sector has been jittery, and multiple compression is a constant gravitational pull when you're trading at 65 times earnings.
Yeah, and speaking of automated stock scanners getting spooked by margins and multiples, there's another landmine sitting in their balance sheet that tripped algorithmic alarms this quarter.
Oh, the debt reclassification.
Yes, the debt reclassification. So MKS has $1.4 billion in convertible senior notes. And because the stock price hit certain conditions in Q2, those notes actually became convertible in Q3, forcing the company to reclassify that entire $1.4 billion as short-term debt.
Yeah, this is one of the most counterintuitive mechanics in corporate finance, and it is crucial to understand.
Break it down for us.
Sure. Convertible senior notes are a type of debt that investors can convert into shares of the company's stock, but only if the stock price reaches a specific threshold.
Okay.
Because MKS executed its business plan perfectly and the stock price surged over the past year, it crossed that conversion threshold.
Right.
So accounting rules mandate that because the debt holders could now convert those notes into stock or demand repayment, the company has to log that $1.4 billion as a short-term liability rather than long-term debt.
Man, it is essentially a penalty for success.
Pretty much.
I mean, for a retail investor or an automated algorithmic trading program scanning balance sheets, suddenly seeing $1.4 billion move to short-term debt looks like a massive, immediate liquidity crisis.
Yeah, it looks terrible on paper.
It wrecks the working capital metrics on automated stock screeners, triggering automatic sell-offs, even though it's purely a function of the stock price performing exceptionally well.
Exactly. It creates a lot of unnecessary noise, but it absolutely contributes to the negative momentum during a highly scrutinized earnings week.
Yeah, but here's where it gets really interesting, though. If we want to talk about things that spook retail investors, we have to look at the insider activity.
Oh boy, yeah.
Over the last 6 months, there have been 40 insider sales of MKS stock and exactly 0 insider purchases. And we aren't talking about mid-level managers clearing out some restricted stock units either. This includes significant sales by the CEO and the executive vice president.
Yeah, that is an optical hurdle that is incredibly difficult for the market to simply look past.
Right, because on the surface, it feels incredibly deceptive. I mean, the C-suite is getting on the earnings call, telling the public that demand is record-breaking and order visibility through 2027 is secure, while simultaneously offloading their own shares. It's like the captain of a ship selling off his personal life jackets while telling the passengers the weather forecast is perfect.
That's a vivid analogy. But this raises an important question about how we interpret insider selling mechanisms.
Okay.
It's crucial to look at the actual filings and, moderate the concern a bit. The executive vice president sale, for instance, was conducted under a prearranged Rule 10b5-1 trading plan.
Okay, let's explain what that actually means for the listener. A 10b5-1 plan is basically an automated schedule set up months in advance.
Right.
It dictates that a specific number of shares will be sold on specific dates or at specific prices, completely independent of whatever the company is doing at that exact moment. The entire point is to prevent executives from being accused of trading on non-public information. So it's not the captain fleeing a sinking ship. It's more like an automated thermostat that was programmed months ago to bleed off some excess heat regardless of the current weather outside.
Yeah, that is a much more accurate way to frame it. The sales are entirely programmatic.
Right.
However, context still matters here. Even with automated 10b5-1 plans in place, a ratio of 40 sales to 0 buys is a heavy tilt.
It's heavily lopsided.
It really is. High insiders selling at a 65x earnings multiple naturally removes a foundational layer of confidence. If you're a retail investor staring at a 7% post-earnings drop and deciding whether to buy the dip, knowing the executive team has been strictly trimming their positions makes hitting the buy button significantly harder.
Absolutely.
The algorithms might have sold off based on margin compression and debt reclassifications, but the lack of retail confidence due to that insider selling undoubtedly kept the stock suppressed before institutional buyers stepped in to establish a floor.
Yeah. So what does this all mean? If we synthesize the underlying financial print, the technological mechanics of the market reaction, the picture becomes very clear. Fundamentally, MKS is executing flawlessly on the structural demands of the AI and semiconductor growth cycle.
Totally.
Their proprietary RF power generators and electroplating chemistries are absolutely essential for the physical manufacturing of advanced technology. Their revenue growth is accelerating across every segment, their free cash flow remains highly robust, and they're actively deleveraging their balance sheet.
Right.
But the stock itself is currently trapped in a battleground. You have management aggressively expanding physical capacity in Malaysia and China to secure their manufacturing dominance through 2027, going head-to-head against Wall Street's short-term obsession with peak valuation multiples, automated balance sheet scanners, and near-term margin compression.
Yeah, it really serves as a fascinating case study in the duration mismatch between strategic corporate execution and algorithmic market expectations.
It really does.
Which leaves you with a final thought to mull over as you evaluate the semiconductor exposure in your own portfolio.
What's that?
If MKS Instruments is truly a foundational enabler, providing the irreplaceable chemistry and vacuum subsystems for the entire advanced electronics ecosystem, and their order visibility already extends all the way through 2027, is it possible that the broader market, with its hyper-focus on quarter-to-quarter margin ticks, is severely mispricing the actual duration and longevity of this AI hardware supercycle?
That is a great question to keep in mind the next time you see a stock punished for aggressively investing in its own guaranteed future. Make sure you follow the show for your daily, no-nonsense earnings coverage, breaking down the numbers and the mechanics that actually matter. We'll see you on the next Deep Dive.